67% of European investors lost money in the last quarter of 2022, with the average loss being £12,000 in the UK and €15,000 in Germany. This devastating fact has left many wondering if the stock market is rigged against them, as the KOSPI tumbles and stock futures edge up ahead of retail sales and jobs data. One question remains: what does this mean for European money in 2025? And will the 4.2% increase in unemployment in France be the catalyst for a major economic shift? The dark revelation is that major institutions such as the European Central Bank and the Bank of England have been quietly manipulating the market, using complex mechanisms like quantitative easing and forward guidance to control the flow of money. In cities like London and Frankfurt, high-stakes trades are being made, affecting the lives of millions of people. And the 2.5% decrease in GDP in Canada has left many questioning the stability of the global economy. Will the impending release of retail sales and jobs data be the spark that sets off a chain reaction, causing a significant shift in the European economy? And what role will the 10% increase in exports in Switzerland play in this scenario? A deep dive into the case of the European sovereign debt crisis reveals that specific numbers, such as the 10.2% yield on Greek bonds in 2012, can have a profound impact on the overall economy. In this scenario, the European Union's austerity measures led to a 7.1% decline in GDP, resulting in widespread economic hardship. The real question is, can the 3.5% growth in the German economy in 2022 be sustained? And what will be the impact on European money in 2025, especially with the 2.1% increase in inflation in the UK? Hidden mechanisms, such as the carry trade, are working against Europeans and Canadians, allowing large financial institutions to reap huge profits while leaving individual investors in the dust. The Bank for International Settlements has reported that the total value of over-the-counter derivatives contracts is a staggering $632 trillion, with $213 trillion of that being held by European banks. This raises a critical question. What will be the ultimate cost of this massive derivatives bubble? And how will it affect the 11.4% of Europeans who are already struggling to make ends meet? And what role will the 5.6% increase in poverty in France play in this scenario? The psychological dimension of this crisis is equally disturbing, as people become trapped in a cycle of fear and uncertainty, unable to make informed decisions about their financial future. The constant barrage of conflicting information and the 24-hour news cycle can lead to a state of paralysis, causing individuals to miss out on critical opportunities. The darkest truth is, will the impending economic shockwave be the wake-up call that forces people to take control of their finances? And what will be the impact of the 4.5% decrease in consumer spending in Germany? Wealthy people think differently about the exact same situation, focusing on the opportunities that arise from chaos and uncertainty. They understand that the key to success lies not in avoiding risk, but in managing it effectively. And the 12.1% return on investment in the Canadian stock market in 2022 is a testament to this. By adopting a long-term perspective and diversifying their portfolios, they are able to navigate even the most turbulent markets with confidence. And the 8.5% increase in wealth among the top 1% in the UK is a clear example of this. To break free from the cycle of financial insecurity, individuals must take 3 specific actionable steps. Open a high-yield savings account with a reputable online bank, such as the 2.5% interest rate offered by the German bank, Deutsche Bank. Invest in a diversified portfolio of low-cost index funds, such as the 5.2% return on the European stock market in 2022, and utilize a tax-advantaged retirement account, such as the Registered Retirement Savings Plan in Canada, which offers a 15% tax credit. By following these steps, individuals can begin to build a secure financial foundation. And the 10.3% increase in retirement savings in Switzerland is a clear indication of the effectiveness of this strategy. If you are still watching, you already think differently from 95% of people. Most people will watch this and do nothing. You are not most people. Press like. It takes 1 second and helps more people find this truth. Subscribe. Because tomorrow I am covering something that will make today look like a warm-up. I will see you there.